Welcome back, everyone. In our last module, we had a look at this legal entity called partnerships, which, to recap, was very much a middle child between a sole trader and a company in terms of its responsibilities and its size. In this last module on for-profit organizations, we're looking at companies or corporations, the legal entity that most big businesses take. Now, most big businesses are what we call publicly listed companies. In other words, anyone can become an owner of the company by purchasing a share in the company. This is where the stock market comes into the play. So when you buy an Amazon stock or a Home Depot stock, you are actually a part owner of the business. You just own an incredibly small amount of the business, usually so small to the extent that you don't have any legal power over the decision-making of the business. And just as a little gag, because like many people, I have shares in tech companies like Apple, Amazon, across the spectrum. I always go around messing with people, telling people that I own a part of a multinational company. Anyways, as I mentioned, perhaps the most important type of business entity is a company. And you can usually identify a company by having one of these abbreviations after its name. In the USA and Canada, you would see Inc. or LLC a lot, meaning Company Incorporated or Limited Liability Company, and these abbreviations indicate that the business is a company. For example, Apple's whole name is Apple Incorporated or Apple Inc. for short. Same goes with the Home Depot Inc., PayPal Holdings Inc., Adobe Inc., Cisco Systems Inc. And in Australia, we have the expression PTY Ltd, meaning proprietary limited. And this is an indicator that the business you're looking at is a company. The expression will obviously vary from country to country, but this type of business is the only one that can be called a company. In legal terms, companies are very, very powerful. The reason is once a business becomes a company, unlike sole traders and partnerships, the business is legally separate from the owner. And the liability of the company is distinct from the liability of the people who own the company. The liability of the company is distinct from the liability of the people who own the company. Another feature of a company is that typically it has multiple owners. By multiple, I mean millions, each owning a very small fraction of the company in the form of shares or stocks in the company. Now, this is one of the most interesting things about a company. Every single person with a share is a part owner. So if you buy an Apple stock, technically you own a part of Apple. You're a part owner, just a very, very small part. Unlike sole traders and partnerships where the owners are the business, in the case of a company, the business has a legal existence in its own right. It exists legally in isolation. The company can employ executives to manage the business and workers who handle the day-to-day operations, but it's the company that is legally hiring and doing this, not the CEO or the key owners. This doesn't mean that they are anything different to other business types in terms of legal responsibility, though, in terms of the key legal responsibilities. Just like sole traders and partnerships, a company has certain responsibilities in the community. It has to obey the same laws as everyone else in that specific country, and it has to pay its taxes. But unlike sole traders and partnerships, companies keep the profits from their business activities unless the key decision makers or owners, usually with the largest percentages, decide to pay a portion of their profits to their shareholders. And they pay this in the form of dividends. Sometimes every half year or 3 months or whole year, you'll wake up and you'll discover an extra maybe $200 in your bank account. That's the company paying you a dividend or a portion of their profits to keep you happy, and it's an incentive for you as the shareholder to invest more in the company. The proportion of the dividend or amount of money that you receive is determined by the proportion of the stocks that you hold in the company. So the more stocks you hold, the greater the dividend payout will be. I mentioned that individual shareholders own part of a business. But if that's the case, how come they have no control over decision-making of a big business like Toyota Corporation or Apple Incorporated? This is because, in theory, as a shareholder, individual shareholders do not control the business unless they have a majority of the shares. In practice, however, sometimes a shareholder who owns a lower percentage can still have a relative amount of impact on the decision that a company makes. And therefore, in some senses, even if you just own a bit of a company, you are in control of it in some senses. So every bit of ownership counts. In the case of a very large company, it's incredibly rare for one person to own all or even a majority of the shares in the company. On the other hand, not all companies are mega corporations. A company can have only 4 employees, but as long as it's legally registered as a company, it follows all the legal obligations and regulations that a company has to follow, including paying company tax, which is usually higher. With smaller companies, it's not uncommon for just one person to own 100% of the shares, or for a small group of people to own the majority of the shares. It all depends on the size of the company. Not all companies are massive. Startups can register as a company if they wish, starting up. Okay, now I mentioned before that companies have limited liability. What does that mean? Well, if you recall with sole traders and partnerships, they have unlimited liability, meaning that owners are not legally separate from the business. And so if a business or a partner incurs some kind of debt under the partnership or the sole trader, the owner themselves have to pay all that debt. The debt is not separated from them. With companies, this is a different case. We have limited liability. In other words, if a large company were to go bankrupt tomorrow, it is theoretically impossible for the bank to ask every single person who owns a share in that company to pay off its loans. In other words, individual shareholders, people who just invest a bit of money into the company and become very small share owners, have limited liability. They have very little control over the company's decisions, but at the same time, they are not responsible for paying off the company's debts. So we say shareholders are rewarded for investing in a company in 3 ways. Firstly, the price of the share that a shareholder holds may increase in value if the company is performing well. The value of a company is based upon its profits. So if profits increase, then so too should the value of its shares. If buying a share in a company costs $31 right now, 31 USD dollars, and the company is doing well, it could rise to $33, and you could sell that to make a profit of $2 for each share. This is in theory. In practice, though, this is not always true and is influenced by a number of external factors, such as how confident investors feel about the company at a particular point in time. Nonetheless, the reward is that as a company's share increases in value, the individual share increases in value at the same rate. Sometimes how a company's share changes in value is unpredictable. Secondly, the company issues a portion of the company profits as dividends. We mentioned this before. The amount of money that each person receives depends on the number of shares that they hold and the number of shares in total. With large corporations, you get dividends paid regularly once every 3 months or biannually. And a lot of people invest in the company because they want to get that regular dividend income that comes with being a part owner of the company. With small companies, this is unlikely to be the case, especially if they aren't making much profit. And so you get cases where dividends are often not paid at all or are relatively small. Thirdly, and to really drill in this point, shareholders have limited liability. One of the single most important features and benefits of owning a company is limited liability. Unlike sole traders or partners, shareholders in a company are not responsible in any way for the company's debts, and we talked about this before, not even those that hold the majority. If the business fails, then all you as a shareholder lose is your investment or the money that you put in the business, but nothing more. Banks can't demand you to pay off the rest of the company's debt. For a company that goes bankrupt, owing millions of dollars or euros to individual banks and other companies, the shareholders do not have to pay any of the debts. The company is the legal entity that owes the money, In this case, the shareholder's liability, we say, is limited to the investment. On the other hand, the risk of a shareholder investing in a company is that the price of the share may decrease in value if the company is not performing well. Just as the share value will increase as a company increases its profits, the share value will likewise decrease if a company is not doing well. In this case, the value of the individual shares will also drop and you will be at a loss. The company may also choose not to issue dividends. There is no legal obligation for companies to issue dividends. Businesses need to keep their funds for many reasons, especially if you're invested in a company that is not doing well. They may not have sufficient cash in their hands to be able to pay dividends. Alternatively, a business that is rapidly growing may need to use that money to support the growth of that business by purchasing equipment or recruiting more employees. For this reason, some companies almost never pay dividends. And if you are looking for dividends when investing in a business, this is a concern you need to heavily consider. Thirdly, as a shareholder and part owner, you only own a fraction of the company. The issue is that you don't have any meaningful say in the decisions about the business. For some companies, such as General Electric Corporation or GE at the end of 2012, to even own 1% of the company, you would need to invest approximately $2.5 billion US. To have 1% of the company already gives you a big say in the decision making of the company. Whereas having 100 shares in a large company, such as General Electric Corporations, means little to nothing at all, because in relative terms, you only own a very, very, very minuscule percentage. So that concludes our in-depth introduction to companies and corporations. We'll spend the next video looking at the difference between public and private companies. See you all soon.